The freer a financial intermediary is, the more it is likely to offer a higher return, and therefore the more people are, in good times, are likely to want to go there. There are many people, and very able and very intelligent people, who believe that the regulation of banks is self-defeating, because they will always find a way around it.
There are rules about what banks can and can't do with our money. As a result, a whole host of other institutions such as hedge funds, money market funds and off-balance sheet vehicles have emerged, which behave like banks, but because they don't call themselves banks, face much less regulation. This largely unregulated activity is called shadow banking.
In order to be able to call yourself a bank, you need to have a banking license. To be a shadow bank, it's very simple because you can provide the same sort of functions that a bank does, only you just don't need to go get the license. Now the downside of that is that you can't then market yourself as a bank to the general public, but of course a lot of these institutions have absolutely no interest in doing that anyway.
Banks traditionally have used shadow banking extensively to get around the rules. Many of them ran internal hedge funds and internal private equity funds that did bank-like things without being a bank. If banking were cheap and easy to do and unregulated, there would be no shadow banking. Banking is expensive, banking is problematic, banking is highly regulated. So shadow banking exists to get out of that spotlight and get out of that focus.
The danger in having sort of two separate terms, shadow banking and traditional banking, is that it gives the impression that shadow banking is wholly separate from traditional banking. This is just completely not correct. There are huge connections between traditional banks and shadow banks, and what's interesting about that is if you actually took steps to limit the amount of exposure that traditional banks and shadow banks could have, then you'd have two effects. You'd make the financial system more stable, and you may actually find a significant percentage of shadow banking disappears altogether.
Frankly, if a shadow bank goes bust, we don't really care that much. It will hurt people, but it won't take down the financial system. Each individual little bit of shadow banking is not very big and doesn't look very important. It's when a whole group of things combine to make a mess, or all of them move in a herd instinct, that they're a problem.
Problems in the shadow banking system actually hugely exacerbated the fallout from the collapse of Lehman Brothers. Money market fund lost a lot of money. It was actually one of a very few number of money market funds that have ever lost money, because these funds are perceived essentially to be risk-free, even though theoretically they're not. The problem was when this fund declared its losses, this then spooked all the investors who'd had believed that essentially their money was completely safe, and this led to a run effectively on the shadow banking sector.
There's actually more banking type stuff going on in the shadow banking world than there is in banks. At the height of the financial boom right before the crisis, shadow banking was larger than banking by a significant margin. It then dropped to being close to banking, and now it's back up to almost pre-crisis levels, which means it is again larger than banking. There's this giant unregulated world out there that is doing stuff that we don't even know what it is.
Several of the main problems in the crisis, 2007-2008, occurred because not very good loans for housing and commercial property were hidden off the bank's own balance sheets in shadow banking format. And when they went wrong, the banks actually had to take them back onto their own balance sheet, if only for reputational purposes.
Banks know what their job is and they screwed it up. Shadow banks were always sort of on their own doing wacky things, and there it's much less intentional. Each individual little piece didn't think they were doing anything wrong, but when you added it all together, it was terrible.
Perhaps the most celebrated kind of shadow bank is the hedge fund, a pool of money which skilled traders invest in public markets. Sometimes staffed by as little as 2 or 3 individuals, many of these obscure organizations spend the day pushing billions of dollars around the world. Because most of what hedge funds do was either banned or heavily restricted after the Wall Street crash in the 1920s, they're not allowed to advertise their services to the public at large. And walking around London's Mayfair, whose streets are peppered with hedge fund offices, you'd be hard-pressed to spot even a nameplate on a doorbell.
There are very strict limitations on who can put their money in. So for example, they're very often invitation only, and the sorts of people who put their money in are high net worth individuals and often investment banks. Because these are so-called sophisticated investors rather than the general public, these funds can then go out and do very kind of risky, exotic, highly structured trading strategies, which theoretically will reap enormously high returns.
It doesn't always take a group of hedge funds to bring down the financial system. Sometimes one is all it takes. In the mid-90s, a team of Nobel Prize-winning economists set up a fund called Long-Term Capital Management from an office in Greenwich, Connecticut. Within 5 years, this enormous institution had rocked the financial world to its core.
Long-term capital management was a very famous, extremely large hedge fund that was founded by some very senior traders from a large investment bank. Everyone had the idea that this fund would be absolutely infallible and would make spectacular returns, and so all investment banks wanted to have a piece of this institution. Of course, things didn't work out as planned and it collapsed.
Clearly LTCM was such a huge hedge fund and had such a dominant position in a limited number of markets that it was felt that if that was allowed to go, there would be problems.
New York Federal Reserve had to essentially mediate a bailout, so they had to get all the investment banks around a table and they all had to agree to put in money to bail this hedge fund out. This was the first sort of alarm bells indication that shadow banks do actually have the capacity to bring down the entire financial system.
In the near future, due to incoming regulations, every time a bank trades with any other institution, a clearinghouse will sit in the middle, asking for the two parties to post it collateral that can be claimed if one of the trading partners goes bust before the trade is over. A clearinghouse will value a financial trade every day and make appropriate collateral demands on the basis of this valuation. If one of the partners goes bust, the clearinghouse is then liable to reimburse the other partner for the value of the now defunct trade.
There is a serious concern at the moment that clearinghouses are too big to fail because all the transactions of all standardized products, including most derivatives, are now being put through clearinghouses. And if the clearinghouse itself should fail, then the effect on all the intermediaries who work through and with the clearinghouse could be devastating.
The clearinghouse is now where all the risk is. So if the clearinghouse goes down, it takes the whole system with it because every bank is using it. There was actually a speech recently given by one of the important people at the Bank of England saying, you know, guys, we've got this great new insolvency regime for banks. That's wonderful. It helped us when Bradford and Bingley went bust, et cetera. We don't have an insolvency regime for clearinghouses. Excuse me? We have a problem. Regulation's really good at closing barn doors after the horses have bolted. So once you've found a problem, they're very good at regulating it and stopping it from happening again. That's a good thing. You don't want to repeat the problem. It can't stop innovation because, you know, bankers make money by coming up with cool ideas. And part of cool ideas is to get around regulation to make it cheaper. So the answer is regulation is always kind of one step behind. It's a good thing and it's an important thing and it does make the world safer, but it doesn't solve the problem.
One doesn't start off with the assumption that shadow banking is wrong, nor does one start off with the assumption that it's right. It's part of the financial services sector that operates certain types of activities. Those activities do need to be looked at and a sensible regulatory framework put over the top. Some of that is, of course, already there. It's a question of what needs to be revised, and you can't make that decision on the hoof.
I think the first thing is to ensure that the regulators get sufficient information, that they know enough. If they really do know enough, They ought to be in a position to assess when the shadow banks are causing the system as a whole to run into difficulties.
Regulators have been trying to make shadow banking more transparent by gathering more information. There's no easy way to say, oh, give us this information, it'll be fine. Because HSBC is clearly big and problematic and you need a lot of information about it. I mean, it's a wonderful bank, but if something goes wrong, it's going to be dreadful for the whole world. 1,000 little hedge funds, most of whose names you don't know, who started last week, you don't even know which ones are going to turn out to be interesting or important.
The difficulty about these areas is that all the changes are detailed and they're complicated. They don't lend themselves to a soundbite, so people say, oh, they're not being done. That's wrong. I think that there is a very real need for all commentators and observers to actually pay real and proper attention to what is happening within the banking industry. Everything is interconnected. You can't actually sort of chop bits up and say, right, that is going to be wholly separate over here. If you, for example, say, right, the banks no longer can have anything to do with say, any hedge fund or any private equity or something like that, well, that would prevent, for example, some of our major multinational companies from being able to hedge the risk of importing raw materials or exporting their goods.
I think what you will see is corporates, like ordinary companies, doing direct lending to their suppliers. So they are going to act like banks without being banks. Say Walmart. The banks in China have been told to stop lending quite so much because their economy is overheating. The cheap t-shirt supplier needs cash in order to buy cotton in order to make cheap t-shirts. So Walmart will lend them money. That's a form of shadow banking because Walmart is not a bank. And so I think you'll see a lot of that. You'll also see hedge funds and private equity, which are investment funds and have cash and need to do something. Traditionally, they've gone out and bought either shares or whole companies. Some of them are now engaging in direct lending. That's an obvious form of shadow banking that is growing very quickly right now.
As the main banking sector is being regulated more and more tightly, some of those activities which previously would have taken place within the regulated banking sector are moving outside it to the shadow banking. So what we're likely to do, unless a bit broader attention is paid, is we'll build up more and more the shadow banking sector, so the risks in there will be rising. Focus on all the banks, because everybody hates banks, they're the ones that we're all going to shoot at the moment, which is the general feeling. And then what happens is you get a problem in the shadow banking sector, which has grown much bigger as a consequence of regulation over here, and back it comes and hits us.
I will try and leave you with one confident forecast that the present financial crisis will not be the last financial crisis. We will always have financial crises, but that does not mean that the effort to try and reduce the impact of such financial crises through regulation is either impossible or wrong to try to do.